All right, everyone, we will go ahead and get started. My name is Kiki Dilly, and I am one of the shareholders here with Altitude Community Law, and I also run our debt recovery department. On your screen, you'll see the PowerPoint presentation in the center of your screen, and this should take up most of your screen. There should also be a small box on the bottom right-hand side of the screen with the video feed. That's the presenter, that's me. And on the left-hand side of the menu, please select the questions and answers icon and type all your questions in there, which will be addressed at the end of the webinar. We have a fair amount of information to get through today, and so I am going to wait until the end to answer any questions, but feel free to put your questions in there and we will answer them at the end as we have time. CMCA credits are automatically generated once the webinar hosting site provides an attendance confirmation report and will be sent via email within 48 hours following the webinar. These credits are not transferable. And please email Summer Sims at ssims@altitude.law or call 303-991-2076. If you have any questions about receiving your CMCA credit certificates, I'll give you her email and her phone again if you want to write that down, ssims@altitude.law, 303-991-2076. And also at the end of the webinar, there is a page with my email on it. And so if for some reason you're not able to get a hold of Summer or you didn't grab a pen fast enough, feel free to email me and I can put you in touch with her to get any of those questions answered. So what we're talking about today is trends in collections and mostly about how HB 22-1137 impacted us. So let's get started. So HB 22-1137 was a Colorado House bill introduced last year, which became law and last summer and became effective August 9th of last year. We're going to talk about how that changed mostly the pre-turnover collection, so the process that you and your boards are going through, you as managers and your boards are going through before you ever send someone into collections, whether it's with an attorney or a collection agency. We're going to talk a tiny little bit about how that changed some aspects of collections after turnover when the attorney gets involved, but mostly the way that the bill was written when it was passed and adopted and made law affected you all a whole lot more than it ended up affecting post-turnover collections. So we're going to talk about what those changes are and what do your boards need to do to be compliant and what do you all as managers need to do in order to be compliant on behalf of your associations that you represent. And to be clear, we're only talking about the portions of 1137 that impact collections. That'll take up our whole hour here today. It also made a lot of changes to covenant enforcement and how that process looks both before and after turnover to the attorney, but we're not dealing with any of that content today. We're just going to be talking about how it impacts collections for unpaid assessments. So what does your board need to do and what do they need to understand about how 1137 changed the way collections work for associations? So your boards, first and foremost, need to authorize an update to their collection policies, their covenant enforcement policy, and their conduct of meetings policy. 1137 specifically says that no collection action can be taken without at least the collection policy being updated. Just because your office is on top of it and following the new rules doesn't mean that the board doesn't have to also update their policies. Not only do the policies or do the procedures that are actually happening need to change, but the policies need to change to reflect that as well. And we were unable and are unable to take any kind of collection action on any matters, whether they were already with our office before August of last year, or if they have been newly turned over to us since August of last year, if those policies haven't been updated. All of those files went on hold. Nothing was able to be done on them until we have those policies updated. So that's a really important message to get to the boards, that any files that were previously with the attorney are now on hold, and nothing is going to be done with them until we have those updated policies. And your boards also need to understand what the new requirements are and the limitations imposed by the updated laws, so that they understand how the collections process is impacted, so that their expectations can be managed appropriately as well. And one example of this is one of the new requirements under 1137 is that the payment plan that you guys were previously offering to homeowners for 6 months of a 6-month payment plan that you were previously offered has now been changed to an 18-month payment plan. And that is a requirement by law that your boards need to understand, that you all have to do an 18-month payment plan. You can't do less than that. And in order to void that payment plan, the owner has to fail to make or pay at least 15 days late 3 times under that payment plan before it's considered void. We can't say they paid one payment 18 days late, so I'm sorry, your payment plan is now void. It doesn't work that way, unfortunately. There is that limitation that we have to wait for 3 payments to be late. So it's important that your board understand what those limitations are, especially with the boards that I'm sure a lot of you have that are rather aggressive and want to move ahead with collections immediately whenever they can. And we just need them to understand that there are limitations there, that they're not able to just, plow ahead as soon as someone fails to pay once. Even though it's super frustrating, it's super annoying, we have to follow the rules. All right, and then we'll talk a lot about what changes the management companies need to make in order to bring your boards into compliance with 1137 in the collections realm. First and foremost, it's really important that you help to coordinate getting those collection policy, covenant enforcement policy, and conduct of meetings policies updated appropriately. Something that we've had a lot of boards attempt to do is to update the policies themselves and then send them to the attorney to try to get approval that they're okay. And usually that usually comes from a good place from the boards, and they think that it's going to save them money. But unfortunately, it usually doesn't. It takes us an awfully long time to try to review a policy that was written by someone else and redline it and send it back and explain the conflicts with the law or sections that were required but aren't there, etc. It's generally going to be more cost effective if you just ask the association's attorney to draft updated policies than to try to have the board draft their own policies for review with the attorney. It's these 1137, as I'm sure you've heard us say before, is really convoluted, is pretty poorly written, and it doesn't make a whole lot of sense to those of us who are attorneys practicing in this area, and we are used to reading statutes and law and figuring out what goes where and what they're trying to say and what the law actually means. This is a super convoluted, difficult to understand, and even internally conflicting law that is really hard for us to get through. So a board member trying to get through it and draft policies is probably not going to be successful in trying to save money. So if you all can coordinate with your boards to get those policies updated and then get them signed and get them returned to the attorney, because we can't proceed with any sort of collections until we confirm that that collection policy has actually been updated and signed. So we're waiting to get a copy of that collection policy back in our files before we can move ahead. So make sure once they do sign it, you're 99% of the way there and you're almost at your goal, but make sure you get a copy of that signed policy back to the attorney so that they know we really have gotten that policy signed. And then you need to actually follow the updated policies. Some of the things, and we'll talk in more detail about a lot of these points, but some of the major things that management companies had to change internally in their own procedures was, first and foremost, holy cow, the notice requirements under this new law. At least one of your notices, and generally it's going to be the payment plan offer letter, has to be sent to the owner by certified mail to the mailing address that you have, posting it to the unit in your association, and then also sent to the unit owner in one of three ways, either by email, by regular mail to their mailing address, or by text. We're going to talk about this later, but that was a major change that management companies had to make with their internal processing of, first of all, that's a lot of certified mail that's going out that you probably weren't previously doing. And then posting to the unit is a huge administrative burden to try to carry. But that was what the law required. And so that's something that management companies had to change in their own policies and procedures for how to comply with that requirement. 1137 limits the interest that can be charged to 8%. So that's something that had to be changed internally in your systems. And probably most onerous on your accounting staff, they had to change how payments were applied. And generally, when you look at a homeowner ledger, it is just a running balance or a running list of everything that is being charged and everything that is being paid to that account. And the running balance doesn't necessarily reflect where those payments, what categories those payments are being applied to, but usually behind the scenes, your accounting systems are taking those payments and applying them to whatever bucket of unpaid category of unpaid balances you've told it to. And prior to the change in the law, associations were required to have in their policy how payments were applied, but the law didn't specify what order that had to be in. We just had to tell people how payments were applied. And usually before, the payments were applied first to attorney fees and costs incurred, and then to things like late fees and interest and administrative fees and covenant violation fines and all of those things. And then finally to unpaid assessments and unpaid special assessments, and then last to that month's current assessment. Well, this requirement or this law completely flipped that on its head and said, here's how your payments that you receive must be applied. They have to be applied first to unpaid, first to unpaid assessments, and then to all that other stuff, the late fees, the interest, the attorney fees, covenant violation fines, all of that other stuff comes after that payment gets applied first to that unpaid assessments. And so your accounting systems behind the scenes had to be switched so that those payments were applied appropriately, so that when you pull those reports, if your boards ask for them about, what does this homeowner owe in unpaid assessments, late fees, interest, attorney fees, etc., those behind the scenes reports needed to be changed to accurately update and reflect how those assessment or those payments have to be applied. All right, and a little bit more. One of the other requirements of 1137 is that the association, and honestly, you guys, the managers, have to send monthly invoices to everyone with a delinquency. Those monthly invoices have to be just that, just an invoice, it's not any sort of a demand for payment or anything like that. It is just, maybe a copy of their ledger or some sort of a statement that says you owe a past due amount to your association. Those get mailed out every month to the owner's mailing address. Now, there is no exception in 1137 for people who are in bankruptcy or for people who are already in collections with a collection agency or an attorney. And generally, we always tell homeowners, once your file is sent to collections, don't have any additional communication with that owner. So your office stops sending out monthly delinquency notices or anything like that. Same thing with bankruptcy. We don't want to violate the automatic stay in bankruptcy by demanding payment from owners. But unfortunately, 1137 doesn't take either of those realities into consideration. And so you all are required to send monthly invoices to everyone who has a delinquency, even if they're in bankruptcy, even if they're in collections. So we have language, and please email me, reach out if you don't have this language. I'd be happy to share it with you, that we recommend adding to the bottom of every single one of these invoices that send out for people who have a bankruptcy pending and for people who are in collections. The one about bankruptcy says, if you have a bankruptcy pending, this is not meant to be a request for payment. This is informational purposes only. The language that we have for people in collections say, hey, if you're already in collections, you need to contact the association's attorney for any additional information. Also, this may not include all the attorney fees that have been incurred in this matter, so please contact the attorney for an accurate current balance. And that way you're complying with all the laws that 1137 has kind of muddied for us. So make sure you're sending out those monthly invoices with those caveats for people in bankruptcy and or collections. All right. And then finally, the last thing that changed, or the last thing that we're going to talk about that changed for you all by 1137 in the collections world, is that you absolutely have to document everything. 1137 specifically says that you're supposed to document any homeowner contact, any attempted homeowner contact, keep copies of all of your documents. When your process server or your employee goes out to post the notice to the unit, you want to make sure you have some sort of documentation from that person saying that they actually posted on the unit. It doesn't matter if it's a picture of the door, but I would advise whoever you have putting those out there, make sure the picture isn't just, the picture is that, which is the letter with nothing really around it to show where it's posted, right? It's much better if you have a further back picture that shows the envelope on the door, but also shows the numbers on the door or something like that. We want it to be obviously identifiable that it was posted on the correct door. It's okay if your process server gives you an affidavit that is, signed and notarized that says, yep, I posted this on this door. That's sufficient for the courts whenever we're serving someone. It's certainly sufficient in this scenario when we're required to post things on the door. So a notarized affidavit from your process server should be just fine as well. Just make sure that everything is documented and that you keep that documentation. Same thing when you send out the certified notice. Make sure you keep the certified tracking number so that we can look it up later if the owner claims that they never got it. Make sure that you keep a copy if the certified letter comes back unclaimed or rejected by the owner. Make sure you keep a copy of that. If you're doing it the old school way with the old green return receipt thing that the owner signs and sends back, or that the post office sends back, keep a copy of that when it comes back. You just have to document everything. That is explicitly required in the statute, but also from a practical standpoint, you want to have all of that documentation and proof if you ever go to trial on a case. And that way we can really easily and clearly lay out to the judge exactly how the association complied with the 1137 requirements. And finally, my last bit of wisdom on this, take it for what it is, but we got to be flexible. There's been talk in the legislature that there might be a cleanup bill this year. It's not this year, it might be next year. There's some level of recognition that this bill was messy and didn't exactly do what it intended to do, and made some things more difficult that they didn't intend to make difficult, and didn't quite hit the nail on the head. So there might be a cleanup bill at some point, and we'd want to, first of all, remain educated and updated when these changes happen. If additional bills come out that intend on cleaning this up or changing things, make sure you do webinars like this. So, good job, you did the first step. Make sure you are signed up for, we have a blog and a monthly newsletter that goes out that we update the blog every single time relevant legislation comes out that might impact associations. So just make sure that you are doing your own due diligence to stay updated with what's out there and what is changing. But make sure you and your company remain flexible, because it doesn't matter how many times they change the law. We have to keep changing with it and roll with the punches and keep updating our processes to comply with whatever gets thrown at us. So moving on to the trends. The bad news is that a big trend that we have seen in the last several months is that a lot of the collection turnovers that are being sent to collections have to be sent back to the management company, because some part of the new 1137 changes were not accurately addressed in the updated letter or process, or somewhere in there something got a little bit sideways and didn't quite comply with the new laws. So we're having to send the whole packet back to the management company and say, look, I'm really sorry, but this little part here got left out, or this wasn't quite done right. And we are actually in a few minutes going to start talking about the top 8 reasons why we have to send files back to the management company to tweak and redo part of their process before we can open up a file, which obviously delays the process and makes everybody frustrated. So hopefully we will resolve some of those issues that we're seeing with you guys being on this webinar right now. So that's certainly some bad news. It has absolutely made things more onerous. It has delayed sending people into collections. It has made the process slog along a little bit slower, and that is frustrating for everyone, except maybe not the homeowners who are not paying on purpose, which is certainly not all of them, but I'm sure some of them were happy to be delayed. The good news is that one of the parts of this bill that got a lot of attention 6 months ago, and even before that, when we knew that this bill was happening but it hadn't gone into effect yet, was that there are requirements in there that the homeowner is permitted to list a designated contact where they want all of their documents to be copied to, all of their communication to be copied to. And also they can request a preferred language, which the association is required to translate all of their notices into. There was a lot of fears back then about homeowners requesting their letters be translated into super obscure languages, or Klingon was the example of choice. And at least from my perspective, I don't think we have seen the avalanche of homeowner requests in that arena that we thought. Certainly there are people that are requesting that letters be translated into, Spanish or French or languages like that were anticipated. But I have not seen the volume of homeowners that I expected to see taking advantage of this requirement and requesting those obscure languages, or a made-up language like Klingon, just to be a pain in the rear. We feared that might happen, but from my perspective, we haven't seen that play out as much as we anticipated. So there's some good news there on the trends. All right, so now we'll really get into the nitty-gritty of 1137 and some of the more nuanced issues that we have been seeing relatively frequently all across the board from a lot of different management companies or self-managed boards, large management companies, small management companies. Everyone has struggled with these changes. So please, if you have had turnovers sent back to you by my office, by another attorney's office, don't feel bad. Everyone is frustrated. Everyone is trying to get their letters and their processes up to up to the standards of 1137. And so we really are just trying to get everybody on board with what needs to happen and what your letters need to say and what processes you need to have. So if you see yourself in any of these, don't feel bad. We are here to solve the problems, not embarrass anyone. So the first issue is what we talked about previously. Your collection policy needs to be updated, not only updated, but also signed and sent to the attorney. We are seeing a lot of issues where we'll get a new turnover, a new collection turnover, and we have to send it back to the management company and say, hey, I'm sorry, we drafted the updated policies for this, but we haven't gotten them signed and sent back to us. So we need to confirm with you guys that that has actually happened. And usually that's a very quick turnaround. It's an easy solution. You guys have that collection policy already signed and in your files. It just didn't make its way back to us yet. And so in those cases, it's just a few days delay, but it's still annoying for everybody, right? So if you can make sure that when you do get those collection policies back into your office, signed by your board, make sure you just forward a copy to the attorney so that they have it on file and are ready to hit the ground running whenever you do send over that next set of turnovers. So that's an easy one to fix. Certainly, if they don't have an updated collection policy at all, that's a bigger issue and a more of a delay. But it's more common for us anyway to get turnovers in that the collection policy has been updated and signed. We just haven't received a copy back. All right, issue number 2. Payment plans. Most of the time, the payment plan offers that are being sent out to the owners are mostly accurate, but sometimes we're missing small pieces in there somewhere. I assume that the majority of you on this call know that one of the big changes of 1137 was that the payment plan offer that previously was to offer a 6-month payment plan is now an 18-month payment plan offer. Most of the letters we see cover that, no problem. Where the issue comes in is the statute in one place says that we have to offer an 18-month payment plan of equal payments. In another place, it says you have to offer payments of up to, or at least, 17 payments of at least $25 a month, which then allows for a giant balloon payment at the end of your month 18. One of those scenarios applies when the board wants to send the owner to regular personal liability collections. The other scenario applies when the board wants to send the owner to foreclosure. So we advise, rather than trying to figure out which one applies where, and is the board really want to send this person to collections? Do they want to send them to foreclosure? Maybe they're going to try collections first, and if that's not successful, try the foreclosure route later, rather than having to go back and do the other kind of payment plan offer letter. We recommend you send out one letter that has 3 options for the owner to pick from. Option number 1 is 18 equal payments. Option number 2 is 17 payments of $25 with one giant balloon payment at the end. And then a third option, which is not at all required, but is a nice option for the owners, is blank lines for the homeowner to offer some other type of payment plan to be reviewed for the board's approval or decision. Any of these options also require the owner to keep their current monthly assessments paid during the payment plan. So even if they pick the $25 a month option, they have to pay $25 a month plus their current monthly assessments to comply and stay current with their payment plan. We have definitely seen some turnovers that we're trying to send someone to collections, but it actually offers the foreclosure payment plan and the other way around. So the easiest way of handling it is just offer both or all 3 with the option for the homeowner to fill in whatever option they want. is definitely your safest way of sending out your letter. All right, issue number 3. 1137 requires that at least one notice, and it's probably going to be your payment plan offer letter, be sent by certified mail, return receipt requested, and posted to the unit, and one of these others. Now we're going to go through each one of these. For the first, the certified mail return receipt requested. Note that is return receipt requested, not return receipt received. So it's okay, you have done your job. If you send out the payment plan offer letter by certified mail and you request their signature and they reject it, it's never claimed, or it's rejected by the owner and it comes back from the post office saying unclaimed or rejected, that's okay. You've done your job, but you need to make sure that you keep documentation of that. You want to keep documentation of the certified number that the post office gave you, and you want to keep documentation of whatever came back. Keep a scan of the letter that says it was unclaimed or that it was rejected, or if they did sign for it, you want to keep that as well. But you don't have to make sure that they actually signed for it and accepted it. That was actually something that was in an earlier version of 1137 that got changed, recognizing that sometimes people just won't accept certified letters. So you do your job. If you get it out the door, certified return receipt requested, and document everything. Now, number 2, you have to post a copy of the letter to the unit in your association. So if you have someone who has an offsite address in Florida, you don't post the letter to their offsite address in Florida. You post it to the unit in the association. You also, like I said, you want documentation of that, whether it is an assigned notarized affidavit from a process server saying, yes, I posted it on that door at this day at this time, whether it's a picture that is date and time stamped by some poor soul at your office whose job it now is to go and post these all over the place. You just want to make sure that you have documentation confirming that that actually happened. And then you have to do one of the following 3. Send it by regular mail to their mailing address. So that's the time when you would send it to the offsite address in Florida. Or you send it by email to an email address the homeowner has provided to the association for association business. Or you send it by text, which literally no one is doing because it's way too much information to send by text, and nobody wants to text owners anyway. So generally, you're doing one of the first 2. You're sending it by regular mail, or you're sending it by email that you have to the owner. So it's really, really important to make sure that that payment plan offer letter is being sent by 3 of those, certified mail, posted, and one of the last 3, and that you're keeping documentation of those. So not only do you want to have the certified mail documentation, the posting documentation, but you also want to note somewhere that which of the bottom 3 you're sending it. So if you're sending it by email, make sure you save that email in that homeowner's file so that down the road we can show the court, yes, we sent it by email. Or make sure that you keep a copy of the letter that was sent to them by regular mail. On the payment plan offer letter forms that we produced, down at the very bottom of the letter after the signature and everything else, there's 5 checkboxes that say this letter was sent by, and you're always going to check the box next to certified mail return receipt requested. You're always going to check the box next to posted at the unit, and then you're going to check one of the bottom 3 boxes that say which of the following it was sent to satisfy that third option. And that way it's a really nice, easy place to keep everything together. You certainly don't have to do that, but if you want to document it that way, that's fine. And again, reach out to me if you want a copy of that little blurb for the bottom of the letters. I'm happy to forward that to anybody. Issue number 4. I know I keep pounding on this, but it's true. You have to document everything. It doesn't do us any good if we get a turnover that says, yes, we sent it by certified mail, and here's a copy of the certified mail information. Yes, we had it posted to the door, and we had it served by a process server. And so here's the affidavit of service from the process server. But I don't remember how I sent it the other way. I might have sent it by email, but I'm not sure. I might have sent it by regular mail. You have to make sure that you're documenting everything. All communication with your owner. So every time the owner calls your office to talk about their balance, anytime you attempt to communicate with the owner. So if you send an email to the owner that gets bounced back for a bad address, make sure you throw that in your file. You're required to keep documentation of all attempts to communicate with the owner. And obviously any sort of compliance. So the requirements, posting and certified mail, etc. You want to make sure you keep documentation of all of that. Number 5, one of the things that changed about 1137 is that the board is now required to vote in executive session to turn people over to collections. Previous to 1137, this was very similar to how boards were required to vote on sending someone into foreclosure. And now they have basically just expanded that requirement to include sending anyone to collections. This means that you can't have any more general procedures that your board agrees to that anyone over, $500 or $2,000 or 90 days or whatever that threshold amount or time was previously. A lot of times managers just had a broad approval that once someone passes that threshold, just send them to collections. That is no longer the case. The board has to talk about each one and vote to send that person to collections. Email decisions are not okay. The board can't make that decision by email. It needs to be in the executive session, and that vote needs to be documented with either a resolution that says the board decided to send this person to collections by a vote of 5-0 or whatever on this day, signed by the board president, or it needs to be reflected in executive session minutes. We just need to have some sort of documentation of that decision. But that is something that was a pretty drastic change from the general procedures from before. And so when you send someone to collections, when you send over your packet of documents, you need to include that resolution or the meeting minutes, noting the board's vote and decision in there with your turnover packet, or we're going to have to ask for that as well. Number 6, interest is now limited to 8%. It doesn't matter if your declaration or your old collection policy or a new collection policy somehow has more than 8% in it. If those say anything different, it doesn't matter. We have to do 8% moving forward starting on August 9th of 2022. But it's important to note, this is not retroactive. So any interest that was applied to the balance due way back when, before August of 2022, can stay at whatever interest rate they were using before. So if they were charging 21% before August, that's fine. Keep all of those interest charges on the ledger as they were. That was the accurate, appropriate legal interest rate that was being charged back then when those interest amounts were added to the ledger. But starting August 9th of last year, you needed to redo the interest calculations so that the interest moving forward after that date was 8%. That's a really easy thing for us to check whenever the new turnovers come to our office. If most associations pre-August had pretty significantly higher interest than 8%, and it's really easy to look at the ledger and see, the interest was about $50 a month before August, and then after August it started being $12 or whatever the difference is. But that is something that we look for, so we just want to make sure that interest is accurately reflected at 8% a year in August. Number 7, application of payments. We talked a little bit about this earlier, but 1137 also changed how payments are applied. So starting in August, every payment received needs to be applied first to unpaid assessments, then to everything else, and you need to make sure that your internal accounting reflects that. Sometimes we get ledgers from management companies that actually do break down each individual payment and what bucket of unpaid unpaid balances that payment was applied to. So if your ledgers do that, make sure that as of August, it changes so that those payments are applied first to the assessments, because that's going to be something that is really, really easy for a homeowner or a judge to grab onto and show that an association is not accurately following 1137 if a payment after August of 2022 clearly says on the ledger it was applied first to attorney fees and then to late fees. Meanwhile, you have an unpaid assessment balance. So make sure that your accounting reflects that. And again, just like with the interest, the good news here is that this is not a retroactive law. And so any payments that were applied to the ledger pre-August 9th of 2022, those were applied however the collection policy provided at that time, and that's fine. You don't have to go backwards and change those, but starting with the payments that were received on August 9th moving forward, they have to be applied first to the assessments. It's not that big of a deal if your ledgers don't specify how the payments are applied, but if they do, you certainly need to watch out for that, because we have seen those ledgers come in showing payments being inappropriately applied after August. All right, and number 8. This unfortunately has been kind of the biggest problem that we have seen with turnovers coming in. And I think that this is absolutely a function of the law being poorly written and convoluted and confusing and just bad. But there are requirements in there that information that seems to be completely irrelevant to your situation still has to be in your payment plan offer letter. And when this information is not included in your payment plan offer letter, we have to send it back to you and ask for the payment plan offer letter to be redone, to have this information in there, even though it doesn't apply in your situation, before we can open a file. So the top 2 examples of this that we see over and over and over again. And so if your management company has received these back because of these reasons, you are absolutely not alone. It seems like everyone has had this same problem. Number 1 is language about what sort of cases can be sent to or be handled in small claims court. That language has to be in there. Doesn't matter that it doesn't relate. That language has to be in there. Second, there's covenant enforcement language that has to be included in your ledger about what steps the association has to go through to try to get a covenant violation remedied before they can take legal action. It's going to refer them to the association's covenant enforcement policy and what needs to be done there. And that language has to be there, even if that homeowner's ledger doesn't have any fines on it for covenant violations. They don't have any open violations, even if they've never had any open covenant violations. They've been the perfect model homeowner, following all the rules until they stop paying their assessments. You still have to include that covenant enforcement language on there. I agree, it's stupid. It's stupid, it's irrelevant, it doesn't matter. There's no caveat to that. There's no way to get around that in 1137. You have to include that covenant enforcement language on your payment plan offer letter, or your attorney is going to have to send it back to you to revise and resend it out, repost it, recertify mail, all that rigmarole that you have to do before you can send someone to collections. Again, if you need that language from me, reach out. I'm happy to send it over. It's just 2 short little paragraphs that needs to be in there in order for that letter to comply with 1137. And it really is crappy and time consuming and costly to have to send these letters back to you guys to revise them and have them reposted and re-sent out certified mail, because that just incurs more costs, right? So we want to try to cut down on that as much as we can, to be able to move people into the process as quickly as we can, because at this point, they've probably been on hold since August. And so we want to get moving, but we have to make sure that these requirements are complied with first. So a little bit of good news is that what didn't change is pretty much everything after you send someone to collections with an attorney or a collection agency. Once you have successfully gotten them out your door and into mine, my process has mostly remained the same. That was not the case with earlier versions of this bill. There were a lot of changes that were proposed, or a lot of parts of the law that were proposed that would have changed the collection process with the attorney. But for whatever reason, most of those didn't make it to the finish line. So once you get that person sent into collections, it is more or less business as usual. And we can proceed pretty much as we always have. And so your trouble ends there, basically. And I'm sure you understand the process once it comes over to my office. But if you don't worry, we'll have a webinar about that as well. Or I'm also happy to come out to any management companies and do a little crash course on what collections looks like once you send it to an attorney, so that you can better explain it to your boards what's going on when you get updates from the attorney. But for the purposes of our webinar today, most of the post-turnover processes were not impacted by 1137. One thing of note, and this is the last thing that we'll talk about today before I open it up to questions, which it looks like we have a lot of questions, so I'm glad we have some time at the end here. But one thing of note is that there has been certainly some trends in the bankruptcy realm that really crash into 1137 and are worthy of note. If a homeowner files a bankruptcy, or if you receive notice of, bankruptcy documents in the mail, or if an owner contacts you and says, hey, I filed bankruptcy, make sure you reach out to the association's attorney right away. Depending on, regardless of where you are in your delinquency letter process, reach out to the association's attorney right away to get some direction on what you need to do. Once a homeowner files bankruptcy, what's called an automatic stay goes into effect, which means that all creditors, including the association and my office and anybody else trying to collect against them, have to completely stop all collection activity. And once they file that bankruptcy, that goes into effect. And if you violate that automatic stay, there can be some really hefty penalties for that. So you want to contact the association's attorney right away. Let them know that you heard that this homeowner filed bankruptcy, or you got some sort of a bankruptcy notice in the mail, and the attorney can pull up the bankruptcy and let you know where they are in the bankruptcy and what needs to happen from there moving forward. Most homeowners will file one of two different kinds of bankruptcy. They usually either do a 7 or a 13, and they're handled very, very differently. A 7 is super quick. They're usually 4 to 6 months, and there's not a whole lot that the association needs to do in there. I would still advise get your attorney involved, because sometimes they can file some paperwork to try to get some money in the right circumstances in a Chapter 7. But in a Chapter 13, those go on for 4, 5, 6 years, and there is a ton of paperwork that needs to be handled and filed with the bankruptcy court right at the beginning of the bankruptcy. And there's really strict, quick timelines for that. And if we miss those timelines, the association very well may lose their right to get paid through the bankruptcy. So you want to make sure that you notify your bank or your homeowner, notify the association's attorney right away that you got bankruptcy notice, so that we can jump in there and make sure that the association is protected through that Chapter 13. And if we wait too long, we might be out of luck. So make sure that we know. That's your takeaway message. But when you're talking to your attorney or to the association's attorney, make sure that you confirm with them what needs to happen with your delinquency notices, those monthly invoices that you're required to send out under 1137, because you need to stop sending out the regular delinquency notices if you're partway through the collection policy process, but you'll still have to send out the monthly invoices to them with that bankruptcy language that we talked about. So it's really important to get very clear instruction from the association's attorney of, nope, stop sending these notices, stop proceeding through your delinquency notices in the collection policy, but yes, send out the monthly invoices, and here's the language to put on there so that you are not only complying with the monthly invoice requirement under 1137, but you're also not violating the bankruptcy stay, because that is expensive. Third, make sure if you haven't filed a lien against the property that you don't at that point, because recording a lien with the county could be considered a violation of the bankruptcy stay. So make sure you don't do that. And it's very important to know homeowner bankruptcy attorneys are really, really aggressive about violations of the automatic stay. We had one a year ago or so claim that one letter requesting payment was worth $10,000 for the owner's pain and suffering that they received from one delinquency notice. Now, they didn't end up paying $10,000, but that's what they were claiming. So they're super aggressive, and we want to avoid any sort of seeming violations or even thinking about violating the automatic stay, because that opens up a whole big can of worms that we just don't want to go into. So bankruptcy, super important to notify your attorney, or the association's attorney. So that is all I had for our webinar today. There is our website, www.altitude.law. We have a ton of information on our website. You can sign up for the blogs. You can sign up for the newsletter. You can sign up for future webinars just like this. We also do evening webinars periodically that are aimed towards board members that have a lot of really good beginner information for your board members about all sorts of different topics. So you can find all of that on our website. Also, that's my email address if you want to reach out to me about anything at all. I'm happy to send the little blurbs that I've talked about, the little information. I'm happy to come out to management companies and do this kind of talk, or talk about what the collections process looks like. Whatever you all think is most useful, I'm happy to do. Just reach out to me. And I will now look at the growing list of questions that we have here. Okay, someone said, does that have to be consecutive? And I don't know what exactly that was referring to. So if you can remind me what we were talking about. Oh, I bet you I know what we were talking about. I bet it was at the beginning when we were talking about homeowners voiding out of their payment plan because they missed 3 payments. They do not have to be 3 consecutive payments missed or late. It can be at any point over the course of the payment plan, your payment plan, the 18-month payment plan. If there were 3 missed or late payments making a payment plan void, does it mean they can ask for another payment plan, or can they go to collections? You can send them straight to collections at that point. A homeowner can always ask for a payment plan, and whatever the board wants to do with that question is up to them. It's now within their discretion whether or not they want to agree to a new payment plan with this owner. They're not required to agree to a new payment plan because they've already voided out of the one that they were required to agree to. Practically speaking, depending on how far through they got their plan before they stopped paying or they missed their payments, it might make more sense to just agree to a payment plan with them rather send them to collections, but that's really up to the board's discretion. They can agree to a new plan, but they don't have to. So if a resident doesn't enter into a payment plan but sends in a partial payment, how are we to proceed? That's a great question. It happens all the time that people send in just kind of a partial payment. It happens here too, that they won't respond to my attempts to contact them. They'll just send in a random payment. That again is up to the board. It might be a little bit of a business decision on whether it makes sense to send the person into collections. If they paid off the vast majority of the balance, it might not make sense to send them. If they only sent in the equivalent of their current assessment, it might still make sense to send them into collections. That's really up to the board's discretion of how they want to handle it given that specific circumstance. I can tell you judges like to see in that situation, and what I do personally when that happens here, I will send them out just one more courtesy letter saying, acknowledging their payment and saying, hey, thanks for this payment, but you still owe this amount. Please call me within 10 days and let me know, or email me and reach out to me and let me know what you want to do. Judges like seeing that effort being put out there, that we really are trying to work with people, but you're not required to. So I would suggest that if you or your accounting team or someone is willing to shoot the homeowner an email, give them a call, document your file of that. If you want to send them one more letter suggesting they call within 10 days or 14 days, just so that you and the boards feel like you did everything that you could do to try to help this person before sending them to collections, I think that that is wise. Can the interest rate be less than 8%? Yeah, absolutely. It can be 0 if that's what the board wants, and pending what their documents say. If their documents require interest, then it needs to be 8%. But the board, most documents will say interest at a certain amount or whatever the board deems reasonable. If that's the case, the board can not charge interest or can charge less than 8. That's fine. If we accept, I think we're still talking about the partial payment. If we accept the money and then they cease paying for a month, do we have to serve them another demand letter? No, you can keep marching through your delinquency letter process as it's laid out in the policy. If they don't either agree to a payment plan or pay the balance in full, you're good to keep moving ahead unless the board wants to reach out again and make another offer. What if the owner is not delinquent and wants to opt out of monthly invoices? That's fine. You're only required to send monthly invoices to people who have a delinquent balance. Monthly invoices to delinquent owners has to be sent by mail, or can it be sent by email? I believe that it is either one. I don't have it in front of me. I don't have that section in front of me right now. I apologize. But I believe that the monthly invoice can be sent by either mail or email to an email address the owner has provided to the association. But I would suggest you either email me or your association's attorney just to confirm, to be sure. Please explain in detail what a posting needs to be done at the first delinquent payment or prior to moving to collection. Ultimately, it depends on what the association's individual collection policy says, because the collection policy is going to explicitly say which letter needs to be posted to the door. So that's the one that you need to post for that particular association. But I can tell you the vast majority of collection policies are written so that it is the payment plan offer letter that is posted to the door. I would recommend taking multiple pictures of the posting. I agree. I've received some that I thought were really, really good, where there was a picture of the letter and then a picture of the letter in the envelope posted on the door, like up close to the door, and then another one a little bit further away that shows the envelope posted on the door little with a picture of the numbers of the house or other identifiable things about the house, like the doormat or things like decorations, things like that, that make it obvious, certainly to the homeowner, what property it was posted to. Can you confirm, you mentioned that we have to continue to send ledgers for delinquent accounts, even those at the attorney for collection and bankruptcy. Yes, that is accurate. There is no carve out in that requirement for those situations, but I do recommend including the language on there so that you are not violating the automatic stay or confusing people that are already in collections. When a collection is sent back to management, does the collection policy need to start over from square one, or can we just complete the one part that was missed and continued on? That's kind of going to be situation specific, but I can tell you most of the ones that we have been sending back, it was issues with the payment plan offer letter, and those have been, at least in the majority of the ones that I see, those are the very last letter that gets sent out, mostly because we're trying to limit the costs incurred by posting and certified mail and whatnot. And so if we have an issue with that final letter and we are sending it back, we are generally saying you need to just redo this one final letter. You don't have to go all the way back to square one and start with the first courtesy letter. We just want you to redo the one specific letter that is probably the final required letter, and do that one to comply with the law, and then you can send it back to us. But if you have specific questions, I would confirm with the attorney that you're dealing with on that particular case, depending on what particular letter it was and where it was in the process. Are you guys recommending billing the translation letters back to the owner that requested? That has been a point of contention, and to be honest, the statute is not clear. I think it is certainly the statute's intent and the spirit of the statute to not have those charges go back to the owner. I could also see potential issues with people claiming that they need the translation in order to equally enjoy in their association like anyone else. And so I don't recommend that translation charges be charged back to the owner, but it is a gray area. It's not something that is explicit in the statute. Can you send a detailed list of the collection steps to take for managers' records? I'm not sure exactly what you're asking there, but if you can email me some more details, I'd be happy to respond. Do updated policies require 30-day comment period by the membership before they can be executed by the board? That's going to be association specific. The association should also have an adoption of policies policy that will lay out the steps that need to be taken before policies are updated or adopted by the board. How would you fulfill the posting of notice at place of residence if it is an empty lot in an association that isn't completely built out yet? We recommend going to Home Depot and buying a little wooden stake and taping or stapling or attaching the letter somehow to that little stake and popping it in the ground at the lot and taking a picture, and you call it good. That's there's no requirement that it be posted to the door. It's just posted at the unit, and that's as good as we can do on an empty lot. We are using your template delinquency notice but are confused. How do we deal with an 18-month repayment plan with a minimum of $25 when the amount owed is less than 18 months, e.g. $25 a month is paid in 12 months? Do we drop below the $25 to stretch it out for 18 months? Yeah. That's what you would do. You would just take the total, divide it by 18, and if that's only $20, then that's only $20. Plus current monthly assessments as due. How does the new legislation affect acceleration of assessments in delinquency situation? It does not affect that at all. If acceleration is allowed pursuant to the association's governing documents, you are good to accelerate however that's written out in the collection policy. And for those of you that don't know what acceleration is, some association documents allow that if a homeowner falls delinquent, the association can call due the entire rest of the either calendar year or fiscal year, depending on how it's written. That year's assessments due right then. And so on your ledger, you would say, this has been accelerated, and here's one giant number. And in the description on the ledger, it says March through December 2023 assessments accelerated. If the association can accelerate, you're still fine to do that. Under 1137, it didn't change it at all. Any reports of people having guns pulled on them yet for posting to units and houses? I have not heard of that, but that scares me too. That is certainly that is a concern that was on everyone's mind when this legislation came out. please type or email the blurb for the bottom of the letter. It's kind of lengthy, so if you could just email me, I'd be happy to forward that over to you. If the board captures votes to refer an account to collections in their minutes, must the board wait until the draft meeting minutes are approved, usually at the next board meeting, before submitting to collections, or a draft meeting minute sufficient? I'm fine with draft meeting minutes, provided that if anything changes between then and when the minutes are actually approved, let me know right away. But I'm fine with draft meeting minutes. You have a board that only meets quarterly and they decide to turn the account over to legal, signs the turnover letter, and then it is recorded in the executive session minutes at the next board meeting. Is that okay? I would advise against that. If they want to call a special meeting maybe to deal just with delinquencies, they can do that. If they decide they want to meet more frequently than quarterly, they can do that. But I am not very comfortable with any sort of action outside of the meeting to approve delinquencies. Can we only offer a payment plan once to an owner if they have entered into a payment plan before? Do we need to offer one again? You do not. If they have opted to accept an 18-month payment plan since August, payment plans prior to that probably aren't enough. You would need them to have agreed to a payment plan since August and then defaulted out of that payment plan. You are not required to offer them a new one. From a logistical standpoint, just an administrative standpoint, it's kind of hard to keep track of who's defaulted and who hasn't. So you're certainly fine to just offer the payment plan letter or offer the payment plan to everybody, even if they're not technically they don't technically have to be offered a new one. You can offer them a new one, but you're not required to. That's only in the case of someone who has agreed to the 18-month payment plan since August and defaulted out of it since then, because they haven't had enough time to pay all 18 months at this point. If an owner has paid assessments for several months to a year in advance, can we just simply deduct the fine amount as long as it does not drop below the current monthly assessment? I think I would need more specifics on that. I think you need to talk to the association's attorney about that specific situation, because I think it depends on when those big payments came in. Because if they came in pre-August, when payments were being applied differently versus post-August, I think that's going to be very fact specific, but I have concerns about doing what you're suggesting. I would like to see the language for the payment plan offer letter. Please shoot me an email and I'd be happy to send that over. Can you give me an example of the correct language to put on a ledger sent to the homeowner with a delinquency notice? Again, send me an email and I'm happy to send that over. It's just too long to try to put in the chat, and then it's going to disappear as soon as we're done with this webinar. So I'd rather email it to you. In regards, on the collection posting to the door, is there any alternatives for, say, a parking space or blank vacant land? Yep, that's exactly what we just talked about. You just post it to whatever you can. You still have to post it though. Also, what's the best way to handle if a customer sends a check with a restrictive endorsements on an attempt to opt out of assessments? Can we return the payments and continue collection efforts? It depends on what the restrictive endorsement says. If it's a restrictive endorsement that says payment in full and it's not, you absolutely send those back. You don't want to accept a letter or a check that says payment in full on it if it's not payment in full, because you're going to be held to that. If it says March 2023 assessments, that's what you have to apply it to, and that's what the law says you have to apply it to. So those ones you're not going to send back. So if it's something other than either of those two situations, I would reach out to the association's attorney to get their thoughts on what you should do with it. But those are the two that I see most frequently, are payment in full when it isn't, and those that you send back, or I'm trying to pay this current monthly assessment, and previous to August we would have sent those back, but now with the law change, those have to be applied in that way, so you're going to accept those. But if it's not one of those two common circumstances, I would contact the association's attorney and get their thoughts. Does the notice posted to the door have to be in an envelope? No, it doesn't, but it certainly doesn't add to community harmony and warm and fuzzies if you're posting a delinquency notice with highlighters and flashing lights on it saying that it's a delinquency notice. I can tell you most of the ones that I've seen are in envelopes. And giving the amount of the assessment in the notice, what if that changes during the 18 months? Do we have to reissue if it changes? No, you don't have to reissue. I just would recommend that you say, for 2013, your assessments are this amount per month. They may change in 2024, and if so, your monthly payments need to be increased accordingly. Is there any specific wording that needs to go on the mandatory monthly invoices for delinquent owners? I would suggest that you email me to get the bankruptcy and collection language. That isn't required. It just brings you into compliance under both 1137 and bankruptcy law. Other than that, there's no magical words that need to be on there other than you need to tell people that they have a delinquent balance with the association and this is how much they owe. If you want to include a ledger, I think that's wise. One of your slides states that a motion needs to be made in executive session to send any account to collections. My understanding is that no motions can be made in executive session. Sorry if I said that. What I meant was that the board has to discuss the particular owner's delinquency in executive session, and because there are personal information concerns, right? The legislation is trying to avoid embarrassment and avoid people's dirty laundry and collections being aired during a board meeting. And so what they don't want to have happen is during the board meeting, the board saying, Joe Smith at 123 Main Street is delinquent, let's send him into collections. Yes, everyone agrees, great. Generally, what is going to happen is that the board is going to go into executive session to discuss delinquencies. They will go through their list of specific homeowner delinquencies in executive session. They will make all the discussions. Then they will come out of executive session and they will move to send all of the people that they just discussed in executive session to collections. And they may identify those on the minutes by like account numbers, if the account numbers don't specifically say names or addresses, something like that. And it will be noted in the minutes of the board meeting that the following accounts were discussed and were voted to be moved into collections. When will this recording be available on our website? I believe it's pretty quick. That's a better question for summer, but I believe it's within a few days that it goes up on YouTube. So that is one more question. Do collection letters have to explicitly lay out the payment plan options, or can we simply ask the customer to propose a payment plan? No, the statute says that you have to offer them, well, the two different payment plans that they lay out in the statute, depending on if you're sending them to foreclosure or collections, and you do have to list out the specific payment plans. You can't just say, please contact us to suggest a payment plan. We don't use account numbers. How is the action recorded in the minutes? That's a good time to use a resolution where the board can just fill out the resolution and say, that way the resolution specifies the homeowner name and address, but the minutes don't necessarily have to reflect that. The minutes can just say that the board discussed delinquencies and voted to send them to collections. Are there concerns with listing the address and privacy? On your meeting minutes, yes. On your resolutions, no. Please make 1137 go away. I would if I could. that has caused a lot of mental pain and suffering in our office and in management companies and for boards. I understand, but we didn't have the option to do that. The overarching theme with the legislation was in trying to not only help transparency, but also protect homeowners from overly aggressive boards that come to their attention because of very specific, very unique circumstances that, in my opinion, don't accurately reflect how collections and boards and management companies and attorneys handle collections in general. I think there were a few really unfortunate situations that got a lot of press, and the legislation reacted to those. Which, to be fair, those were bad situations, right? But they made a lot of really difficult situations that good boards and good attorneys and good managers now have to deal with. So, we are where we are, unfortunately. I think that most of these probably came with good intentions. They are just really administratively difficult for boards and managers. So unfortunately, we have the law and we have to comply with it. So that is everything that we have here today. Please, again, reach out to me if you have any questions. I'm happy to answer questions, or come and meet with your boards, meet with your managers, whatever would be helpful to you all on a more one-on-one basis. But otherwise, that's all we have for today. So I thank you all for attending, and have a good rest of your day.